S3 Partners tracks every short and long position across thousands of funds, and their data shows something extraordinary. The Magnificent Seven now make up nearly 20% of all short positions. But S3 founder and managing partner Bob Sloan says investors aren't short because they hate mega cap tech. It's just the only way to hedge in this market. And Bob joins us now on set. Bob, I thought your data was really fascinating, and to me, a huge surprise as well. But it's not about like the ROI concern. It's just about there's no other way to hedge.
That's exactly right. So what's happened is that everybody thinks that the short interest in NVIDIA, which is about $45 billion, means that people hate the company. That's not it at all. What's happened is that the Mag 7 is such a concentration of every index, and it's the biggest short interest collectively. We've never seen a market where the most owned stock is the most shorted. That's what makes this environment different. It's really different because the way you get an hedge exposure, and I think you mentioned this in your last segment, you have to short these 7 stocks. And how do you outperform? You have to go long stocks that are a little bit out there, high momentum. And so what we're seeing is, in our long data, you're seeing that the high momentum stocks are just, there's a little bit risk off, and this is causing a lot of atmospherics, a lot of tension. But it's just a risk off trade, nothing more.
It's the kind of thing, though, when you're shorting these companies that could cause you to close your hedge fund, a la Michael Burry. Him making this announcement that the markets no longer make sense to him. He, by the way, did tell Bloomberg that he's continuing to trade just with his own and family money. But just how painful is it to try to hedge this thing? Maybe it looked good over the past week, but for the long term, it's been a very, very terrifying prospect to short these companies.
Well, but what's happened to folks is that the market structure, and every time I say that, I know the audience goes to sleep, but it's a real thing. And so what's happening is that someone like Michael Burry, what's happened? They want to short a particular Mag 7, but to hedge it, they actually go long the most shorted stocks. So there's all sorts of ways. It's like we've met the enemy and they're us. So shorting and getting that exposure to the marketplace is very, very, very difficult. And even the best, right? This guy called 2008, he had it right, got it totally wrong. It's a hard thing to do.
So how do you hedge in this market, or what, what risks would make any decent hedges stop working?
Well, that's a great question. So what would make a hedge stop working? What would make the Mag 7 not correlated to 1 to the rest of the marketplace? Well, is there a MySpace, Facebook, Meta moment? Is there a competitor out there that can displace them? Not necessarily on the horizon, right? Is there any trust to break them up? Not under this administration, right? What other factors are out there? And so people are very nervous about the circularity of some of these investments, right? Compute for investment. I think what that's actually doing is making the Mag 7 an even more important part of the index, because they're actually going to the place where they need to compete. And they're actually making it harder to displace them. So you have to short the Mag 7, right? And so you have a lot of folks out there talking about 1929, right? That's like a may I meet you moment. It's an analysis that was good 40 years ago, but has nothing to do with what's going on in the marketplace today. Nothing.
We should probably explain that Bill Ackman recently said on X that the way to meet women is to go up to them and say, may I meet you? So Bob is saying that is outdated, much like...
Right, and so what was, I'm talking about Burry, in 2008, what did he do? He shorted the AAA, and he went long the things that were not AAA. What are people doing today? What's AAA today? The Mag 7. They're shorting the Mag 7, and they're going long things that are not Mag 7. So that's why I say 1929, no, not really. That is something to keep your eye on. If the Mag 7's not correlated to 1, that's...
Can I ask one other issue that Barry points out is depreciation, right? These are things that would ruin the AI trade, as you point out, a competitor coming in, substitution risk, pricing pressure, power bottlenecks are one that everyone talks about. But no one talks about, except for Michael Burry recently, depreciation, right? These guys that used to be asset light, as Danny points out, now own all this stuff that's worth less the moment you drive it off the lot.
Right. But what's more powerful? Valuation or positioning in this market? I think he found out. Positioning, way more important. Technicals drive price action. The valuation will matter. I'm not saying it doesn't. But eventually, today, it's all about the Mag 7 concentration and whether it correlates, whether it's giving you the exposure that's one-to-one correlated with every other index.
So just to be clear, if there was some real pain, all of this just makes a fire sale more likely. Is that kind of the outcome?
No, I think what it means is that the high momentum stocks fall, because that's how people have tried to outperform.
Right. And
going long those stocks and shorting them.
But to be fair, it's had some wobbles recently. Some of those like junkier things that had momentum have started to backtrack.
No, that's absolutely right.
But does that suggest that something is changing about this market and is, I don't know, becoming healthier, for example?
I think Bob Diamond was on. I think he had it right. It's a pullback. You look at these things. We track what we call battleground stocks, which is where the long and shorts are basically equal. So we track what's active long versus what's active short. We're at a record number. So it's telling you people are shorting a lot of the Mag 7. That's how they're getting that exposure. And they're trying to go to these places where volatility and daily trading means a lot. And the number of those stocks has increased, almost doubled this year.
We have a skeptic writing in. A viewer points out that even though these absolute numbers may be big in terms of what's short on NVIDIA, they're a tiny percent of its float, right? 1% of NVIDIA's float. He's saying 1% of Google's float is short, less than 1% of Apple.
We're saying the same thing. We're agreeing. We're saying 1% of float doesn't matter. What does matter is that it's giving you exposure to the rest of the marketplace. That's what matters.
What about hedging via CDS? We've seen that recently. Oracle, CoreWeave, spreads have started to widen. Is that a fruitful area that investors are looking for? Is that what we're seeing there, just hedging exposure?
Look, people are going to challenge the spending and the capex of these companies, and they're trying to find inventive ways of doing it. Maybe they don't like shorting stocks, or maybe they're not a equity investor. They are a credit investor, and they look at CDS and they say, hey, you know what? Too much money being spent. We don't believe it. Let's go buy CDS.
Bob, this has been excellent, and we'll see if those hedges pay off tonight with NVIDIA earnings. That's S3's Bob Sloan.